welcome back. You're still watching The Money Show on ET Now. Time to touch base with our next guest on the show to take the conversation forward with respect to markets and where your personal financial planning should be headed. We have with us Harshvardhan Roongta joining us. Ms. Roongta, thank you so much for taking time out and joining us this evening. With the Sensex hitting 50,000, what is the lure of gold like right now?
Karunya, when we talk about equities and gold, so you picked up two important points. The market's an all-time, touched 50,000 as an index, and gold being a very important asset in investors' portfolios. So we see gold and equities are inversely related. So ideally, you would see when when markets go up, you will see gold prices coming down. Now, when you look at an investor's behavior, I mean, ideally, we all aim to basically buy when the markets are low and sell when the market is high. So right now we are in a lifetime high situation when markets have hit up 50,000, which is a lifetime high. Invariably, you will see the retail investors' behavior is exactly the opposite of what should be. So we will see more retail investors coming in to invest into equities now when it would be time to actually review your portfolios and try and actually rebalance the portfolio, sell some bit of equity and get into something else. So at this juncture, I would say all investors who are invested in equity or are planning to come in, be very mindful of the asset allocation plan that you have in place. So in case you've been investing in equities and the ratio has gone up because the valuation is going up, it's time to do a review and actually do a rebalancing, which means that you might have to sell equities and invest more into, say, gold for that matter, or debt in that case.
Okay, all right, point taken. But could you also tell us what percentage of one's portfolio should be invested in gold? Because the way the markets are performing and the amount of interest that has really come back in mainstream equities, how much would be a reasonable amount to still have parked in the yellow metal?
Essentially, at the beginning of any financial plan, we normally suggest that gold should be a part of the portfolio, of course, because gold is a hedge against inflation, and the returns that we expect gold to give over a longer period of time would be in line with the inflation rate. So that's one of the assets that you will certainly have in your portfolio. In all probabilities, having an allocation of about 10% of your investable corpus into gold is an ideal allocation. Now, when we talk about 10%, we include only the pure investment. We're not talking about any jewelry that you would have for your self-use or an ancestral jewelry, which is basically inherited and just goes on from one generation to the other. So 10% of your investment portfolio into yellow metal, I think, is a decent allocation to begin with.
Okay. Indians in particular, of course, as we all know it, have a good amount of gold in the form of jewelry belonging to their family members and even the one that one purchases. The value can be huge. Is that considered when determining the percentage exposure to one's portfolio? Will that be counted?
Well, not really. As I said, when you're looking to create an investment portfolio, to basically achieve some goals in the future. So you would have some goals such as planning for your children's education, marriage, your own retirement, holiday, etc. Now, invariably ask the question to yourself: if you had jewelry which is for self-use, or there is some ancestral jewelry which you've inherited, what is the likelihood of these being liquidated? So are you likely to sell this to meet those goals? Most certainly not. So anything which is not going to be liquidable cannot be forming a part of asset allocation. So as I mentioned, jewelry which is for self-use or any ancestral, jewelry, or even your house for that matter. So if you're staying in an apartment which is your own, what is the likelihood of selling that for meeting any goals? You would not do that. So you would not take that real estate into your asset allocation plan. So very clearly, a 10% allocation is purely that quantum which you can sell, which you will liquidate to meet your goal. If you're not going to liquidate anything, it doesn't form a part of your asset allocation.
Okay, fair point. To what extent should this be looked at as a return generating asset as far as gold is concerned, especially after what it did in 2020 and how it sort of yielded massive returns for people who were holding on to this commodity?
So, Karunya, very simply put, I mean, gold is an asset which will generate some returns. We're not looking at an asset which is just going to be lying around by itself. So, when we mean a 10% allocation, we're certainly expecting it to even generate some returns. It's not like a cash lying at home, which is for emergency funds. So, this is going to help us meet certain goals in the future. The return expectation of gold, as I've been mentioning, is it's a hedge against inflation. So, we expect a long-term return from gold to be in line with inflation rate. Though, as you mentioned, year 2020 had been exceptional for gold. I mean, we've seen the kind of returns in the last 1 year. If you just look at 1 year, 3 years, 5 years, 7 years return, 1 year return has been approximately 20%. If you look at a 3 year return, it's been about 16%. We look at a 5 year, it's 12. But if we look at a longer 7 year return, it's about 7%. So we are certainly expecting a return which is in line with inflation rate out of gold. Not that it's not going to generate any return. But an investor should keep in mind it is not that you will get this, a positive return in all the years. There could be certain times when you will even see negative return. So the year 2020 had been exceptional. You've got a 20% kind of a return from gold, but expecting the same year on year going further, it's not going to happen. So you will find some periods which are just about flat. The gold price will remain as it is for like probably 1, 2, 3 years. It may take even a dip or it may just go up. Overall, over a longer period of time, a rate of return which is in line with the inflation rate is something that an investor should be looking at.
But what about the form of gold? I mean, physical gold versus paper gold. What would you sort of pick?
Why would people buy physical gold? Let's understand that clearly. So physical gold, that touch and feel factor. You'd like to have it with you, see it, use it rather for that matter. In case we're looking at pure investments, which are also liquidable in future, so you don't want to be emotionally attached to it. So if you have a lot of gold in your hand and then suddenly you get emotionally attached to it, it becomes difficult to even liquidate it. So if you're looking at a pure investment to be used for your goals in future, which means it has to be sold at some point in time, looking at the convenience, looking at the purity levels, looking at everything, paper gold is certainly a hands-down winner in this category. Of course, if you're going to use it for your self-use, then you need to buy physical gold. But in case of a portfolio allocation in terms of asset allocation, paper gold is the best way to go about investing in gold.
Okay. Within paper gold, now we have several platforms which offer digital gold, for example, in Upstocks. Then there's also income generating SGB. How does one pick and choose when there are so many choices out there, or should there be a little bit of everything?
So frankly speaking, I mean, nothing beats the fact that, we are investing in gold for the appreciation in price, which all these forms of investments will offer. But SGB, the sovereign gold bond, has one unique advantage to itself. It gives an investor a 2.5% interest every year. So if you land up holding for the entire period of, say, 8 years, you have a 20% upside just by the fact that you're investing in SGB, which is not available in any other form of investing in gold. So I think the sovereign gold bonds is the most superior form of owning gold. And the next best that comes to it in terms of convenience, safety, etc., no hassles of storage and all that, is the gold mutual funds or the gold ETFs, which are offered by mutual funds. So I think between the sovereign gold bonds and gold funds or ETFs, I mean, your investment purpose is resolved. I don't think you need to go for anything beyond that. And if you can manage the sovereign gold bonds, please stick to that for itself because of the 2.5% interest that you get additionally over and above everything else in gold. So I think that's the most superior form of investing.
Okay, Mr. Roongta, I think we've covered it all quite extensively. Thank you so much for joining us and for educating our viewers as well to make the right choice between gold and equities.